ask the board to approve our virtual procedures for today's meeting. So a motion to adopt the new procedures has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Francois?
I approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul? We have Paul on the virtual meeting procedures. Yeah, come back. Kellen?
Approve.
Carol?
Approve.
And I'll just check back to see if Paul is able to be heard. Okay, motion carries unanimously with those who are able to vote. We'll note that item 2, the minutes from our April meeting, will be submitted for approval in June. And so that moves us into item 3, motion to approve 145 pension applications and 71 withdrawal applications have been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll call. Brian?
I approve.
Francois?
Approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul? Back to Alan?
Approve.
Carol?
Approve.
And I'll come back to Paul.
Jackie, can we see if Bill is he in?
He is in, he's muted, and it looks like he's trying to unmute. Paul, can you try and unmute? Oh, you are unmuted, so they just need your vote.
Jackie,
Jackie, can you repeat what the what's up for Paul?
Yeah, Paul, we're voting on item 3, the pension applications and withdrawal applications. Bill, are you able to call him on your cell like we've done for others in the past?
I can.
See if that works. And Jim, I'm gonna say that the vote carried unanimously based on who's able to participate.
And just move on.
Yeah.
Hey, Paul, for some reason, they're not able to hear you on the.
Well, so Jackie, for 3, you can move
Yeah.
on.
The
But
motion,
go ahead. I was going to say, but for 4, let's see if we can get Paul on.
for 3, the motion carried unanimously. And let's check in with Bill before we go through these items.
I have Paul on the line.
Hey, Paul, could you speak just to make sure this approach will work?
Yeah.
Okay, great.
Well,
We can hear you.
What is something wrong with the computer?
Okay.
I don't know.
Well, it sounds like we can have you cast your vote via phone for section 4. So we're just going to start that section.
Okay.
Okay, great. Thanks, Bill and Paul.
Sure.
Okay, section 4A, a motion to approve the service-connected disability benefits for James H. Harvey has been made and seconded. Any discussion on this item? Hearing none, I'll go to the roll. Brian?
I approve.
Francois?
Approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approve.
Motion carries unanimously. 4B, a motion to approve the service-connected disability benefits for Kimberly A. Boone has been made and seconded. Is there any discussion on this pending item?
Jackie, this is Carol. Is it possible to have, we're at 4B, right?
4B, correct, Carol.
Right. Can we have the motion to go to a hearing panel?
Is that for additional information, Carol?
Yes, for different information and clarity and opinion.
Okay, so there's a motion to send 4B to a hearing panel. Is there a second?
Second.
So a motion has been made to send case 4B to a panel, has been made and seconded. Any discussion on the revised motion? Hearing none, we'll go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
I approve.
Paul,
I approve.
Helen,
I approve.
and Carol.
Approve.
The motion carries unanimously. 4C, a motion to approve the service-connected disability benefits for Tayani S. Kenner has been made and seconded. Is there any discussion on this pending item? Okay, hearing none, I'll go to the roll. Brian,
I'll abstain.
Francois,
Deny.
Marcia,
deny,
Roosevelt,
Abstain.
Paul,
Abstain.
Helen,
Deny.
and Carol.
Yep.
I'm sorry, Carol, for 4C.
Abstain.
Thank you. The motion fails 0-3 with 4 abstentions. 4D, a motion to approve the service-connected disability benefits for Sergio A. Rosado has been made and seconded. Any discussion on this item? Hearing none, I'll go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
I approve.
Paul,
I approve.
Kellen,
I approve.
Carol.
Approve.
Motion carries unanimously. 4E, a motion to approve the service-connected disability benefits for Michael A. Covington has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
Approve.
Paul,
I approve.
Kellen,
I approve.
and Carol.
Approve.
Motion carries unanimously. 4F, a motion to approve the service-connected disability benefits for Eric Enders has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
Approve.
Paul,
I approve.
Kellen,
I approve.
and Carol.
Approve.
Motion carries unanimously. 4G, motion to approve the service-connected disability benefits for Christine M. Walsh has been made and seconded. Is there any discussion on this pending item? Hearing none, we'll go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
I approve.
Paul,
I approve.
Helen,
I approve.
and Carol.
Approve.
Motion carries unanimously. 4H, a motion to approve the service connected disability benefits for Kristen Mooney has been made and seconded. Any discussion on this item? Hearing none, go to the roll. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
I approve.
Paul,
I approve.
Helen,
I approve.
Carol.
Approve.
Motion carries unanimously. 4I, a motion to approve the service-connected disability benefits for Tahira Morales has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll call. Brian,
I approve.
Francois,
Approve.
Marcia,
approve,
Roosevelt,
Approve.
Paul,
I approve.
Kellen,
I approve.
and Carol.
Approve.
Motion carries unanimously. That moves us into new business and the executive director's report.
Good morning. The PAF is on schedule, so I want to just thank the OIT payroll personnel folks for very, very good work on this. This is their this is new to them, right? There hasn't been a PAF in about 6 years, so a couple new employees. So it's good work by them, and I appreciate all the work that they and staff, internal staff, are doing on the PAF. PAF notice letters will start going out this afternoon and tomorrow. We tried something a little new this year. We wanted to get the letters out just a few days before the payment would be sent out. We wanted to be somewhat contemporaneous, so it would be fresh in people's minds. So the recipients will be getting their letters by next week, going out today and tomorrow. So that's a good thing. The trustees, Carol and a few others, have requested a copy of this sample letter that will be emailed to you this afternoon. We will be meeting on Friday, and by we, I mean Brad, and I believe Bina, and possibly Mr. Myers will be in the meeting from Nationwide, and myself and a couple other folks meeting with the Parking Authority team. They have expressed interest in they already are members of our pension fund. They have expressed interest in participating in the 457 plan, similar to how the PHDC employees did several months ago. So we'll be having that meeting on Friday, and that's a good thing. It's a testament to how well run the plan is, what a good job the board does and Nationwide does. So I think that's a good thing, but we will keep you updated as that progresses. And I think that's everything new that I have.
Thanks, Fran. Is there any other new business before the board?
Fran, good morning.
Hey, good morning, Carol.
Hey, Jack,
Go ahead, Carol.
can you hear me? Yeah,
Yes.
Fran, that is good, but I just want to make you aware that I believe Parking Authority already have a investment team in there doing like deferred comp, but just to be aware so we know what we're going up against.
I'm aware of it, and
Okay.
Because our fees are good, and
Right.
because of what they're really interested in our plan. So yes, no, I appreciate that. Yes.
Yeah, I'm glad to hear, because a couple people called me about it, and I'm like, that's not our plan, so we need to look at it. We have a plan that'll work better, but thank you.
Yep, you're welcome. Thanks for the info, Carol.
Thanks, Carol. I'll note that the litigation summary is included in the board packets for your review. And a motion to adjourn has been made and seconded. Hearing no objections, the motion carries unanimously, and we'll move into the deferred comp portion of our meeting. The first item is approval of the minutes, and that has been made and seconded. Is there any discussion on this item? Okay, hearing none, we'll go to the roll. Diana,
I approve,
Brian,
I approve.
Marcia,
I approve,
Roosevelt,
I approve.
Paul,
I approve.
Kellen,
I approve.
and Carol. Carol, do we have you on the deferred comp minutes?
Yeah, I approve.
Thank you. Okay, motion carries unanimously, and we'll move into the plan update.
Good morning, everyone.
Good morning.
Good morning.
As of April 30th, the ending balance in the deferred compensation plan was $1,250,000. $643,440,963.09. That's 4% less than the month of March. Total participant counts did increase at 24,610. That's 57 more than last month. Actively deferring is 19,180. We saw 50 more than the previous month. New enrollments, total received in month of April is 50. And inactive participants, total participants 5,430. That's 7 more than previous month. In the 401A plan, the ending balance as of April 30th is $1,808,356.12. That's 6% less than the month of March. Total participant count is 861. That's 2 less than the previous month. In terms of call volumes received and handled, the total calls that we handled is 3,081 in April. That's a decrease of 269 less calls since last month, which was the statement time period. A total of 17,641 or 72% of participants have set up an online account. They're leveraging the tools and resources that are available, which is a good thing. And it's a high concentration at 72%. In terms of percentage options, there are, as of April, 1,153 participants that are enrolled in the percentage option. That's 39 more than the month of March. In terms of after-tax contributions, that's the Roth 457. As of April, there are 4,490 participants. That's an increase of 134 participants since March, with a total plan assets at 21.6 million. Any questions before I pass it on to Brad to discuss the service activity report? Brad?
Perfect. Good morning, everyone. So for the month of April, we had 49 one-on-one individual consults with participants that resulted in 52 enrollments for the month done by the local team. There were 10 group events, workshops, both webinars and seminars in person, with a total of 152 attendees. 9 of those events were new employee orientations. We did have a new paramedic class, 2 new sessions at District Council 47, and 23 of the individual one-on-one consults were conducted using the My Interactive Retirement Planner. Thank you. Happy to answer any questions if there are any.
Thanks, Brad and Bina. Any questions from the board? Okay. Hearing none, a motion to adjourn the deferred comp portion of the meeting has been made and seconded. Any discussion? Hearing none, we'll move into the investment committee. Bill, do we have Rob on yet?
I don't see Rob on yet.
Okay, I'll do the meeting minutes and then hopefully he'll be on. So the first item is the approval of our April 2022 investment meeting minutes. Motion to approve has been made and seconded. Any discussion on the item? Hearing none, we'll go to the roll. Diana?
Approve.
Brian?
I approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approve.
Motion carries unanimously, and that moves us into item 2, Siegel's annual shareholder and proxy review.
Good morning, everyone. This will be our annual shareholder and proxy review. We have Maureen O'Brien from Siegel along with her colleague, and turn the floor over to her to walk through summary of the board's activity over the last 12 to 18 months, as well as plans or proposed plans rather going forward. There's also some recommended changes to the proxy guidelines that Maureen will go through. So floor is yours, Maureen.
Thank you, Chris. Thanks for having me on today. I think we're actually going to start with the memo, which I think was back of, yeah, there we go. All right, so I have 4 documents submitted for this meeting. The first is a memo on the shareholder advocacy work, which I'll review first. Then we have the recommended changes to the proxy voting policy. You have with you a clean copy, assuming you're okay with the changes, and then a redlined copy, which I'll walk you through. And then lastly, I have a PowerPoint deck, and that is to help pull out key summary items that we also provide in our corporate governance report. So our annual reporting to you is a proxy voting report that shows every vote we cast at every meeting with the rationale, and then we submit a yearly corporate governance report, which is a glossy magazine style report that we hope you'll read. The proxy voting report is more of a reference if you want to look up a particular vote. Okay, so we'll start with shareholder advocacy, and please feel free to interrupt me with questions as I go. As you know, we have worked together for many years to advance ESG with the publicly traded firms that you hold shares in, and we have particularly focused on diversity, executive compensation, and political disclosure, and we continue to be active in those areas. In last year, in 2021, the system filed shareholder proposals on what we nicknamed the Rooney Rule, and that's a policy where the companies commit that for every open search for a board director, they will include women and underrepresented community members as part of that search. We have expanded that ask a bit in 2022. So in 2021, we had success at 2 companies, Royal Gold and St. Joe Company. Both of those firms adopted that policy. We also reached out to Electric Arts and submitted a proposal on pay parity. There was, the company was in the news, its employees had shared a list of salaries throughout the firm, and there was pretty wide reporting on the disparity in pay among gender basis. So we asked the company to investigate and report on pay parity. We were focused on gender, and we also raised the issue of racial pay parity, and the company agreed to cover both of those aspects and to issue a pay parity report. So good success there. Also at US Silica, we have been looking into a particular aspect of executive pay over the last few years. This partly was driven by our work through the Say on Pay working group, which Siegel Marco co-leads with the AFL-CIO Office of Investment. And it was also brought to our attention through another coalition, the Investors for Opioid and Pharmaceutical Accountability. Essentially, what happens is most companies structure their pay on the annual cash bonus plan and the long-term stock incentive plan to align with shareholders. So while CEOs get paid typically $1 million a year, most of their compensation is through these stock plans, which are based around metrics such as earnings per share. But in their calculation to figure out what the payout is going to be under those 2 plans, the companies calculate it differently than they would under GAAP. So they report out earnings per share for investors, and then for executive pay purposes, they exclude certain items. And one of the items they exclude is legal costs. And that's where it came to our attention through the work with opioid supply chain companies is, and I'll touch on this later, these companies were booking huge multi-million-dollar settlements and excluding that from executive pay. We saw US Silica also was engaged in this practice, and so we submitted a proposal asking for the company to be more forthright in how it was calculating, rather than just produce the end number and provide the calculation in a separate securities filing. We wanted to see the adjustments in the proxy statement, which is what we're reviewing when we're voting on the executive pay plan every year. The proposal went to a vote, but when the company put the proxy out, they did implement most aspects of the proposal. So we got a high vote, 43.8%, and we had partial implementation. At Chevron in 2021, we also filed a proposal on political disclosure. The board has heard me talk about this for years. We have chipped away at Chevron's political spending, and each year they seem to take another step towards fully disclosing their political spending. In 2021, we didn't think they went far enough, so we kept the proposal on the ballot, and that proposal also received a high vote of 48% support. Moving on to this year, 2022, we continue to submit proposals on inclusive recruitment policies for board of director searches. We have proposals pending. We have a proposal pending at Fox, and we saw success at Gaming and Leisure. That company adopted the Rooney Rule, and it also took some other steps that we had discussed with the company, which is to add photographs to the proxy statement and to add a board matrix for the board members. We do not have consistent data around race for corporate boards. We're seeing that change dramatically, especially the last 2 years. We've seen a big improvement in companies providing the racial composition. If we don't have the racial composition, we can't vote, and we can't do, it's not as easy to do advocacy around it. So we're happy to see the company provide that transparency as well. Moving down to the second page, we have 6 additional proposals planned on inclusive recruitment policies at the companies listed here: EVI Industries, Legacy Housing, Organogenesis Holdings, Pure Cycle, National Beverage Corporation, and World Acceptance Corporation. And then at Chevron and US Silica, where we had such good votes, we refiled those proposals for 2022. And at US Silica, the company did those last steps, which was providing a reconciliation table of what the payout would have been under GAAP and then what their calculation was and what they excluded. And at Chevron, for the first time, they agreed to disclose their political spending through trade associations and other third parties. That's been a sticking point for us in their disclosure. So a good effort there. Lastly, through the Say on Pay working group, we wrote to 3 hospitality firms that this is Hilton Park Hotels and Resorts and Xenia Hotels and Resorts. I'll show you the numbers in the deck. But essentially, these companies were seeing depressed share prices given everything that's going on with COVID and the lack of travel. And they had massive layoffs among hotel workers, but at the same time, they were boosting executive pay. So we took issue with the misalignment there of supporting their top workers, but not the rest of the workforce. So any questions on shareholder advocacy before I move on to the proxy voting policy changes? Okay, can we show the redlined version of the proxy voting policy? Great, and we can move to page 39. Okay, if you scroll down, you'll see the red font. We have 3 recommended changes to your proxy voting policy. Oh, maybe this is the clean copy. Right, I think it's 39 as listed in the document rather than the. It's item 13.8. Great. Okay, we can scroll up a little bit. So the first item we have is on SPACs. These are an alternative to a traditional IPO process where a holding company is established. It's a special purpose acquisition corporation, and that entity has 2 years to find a private company, merge with it, and bring that private company public. At the point that it becomes public, there's new shares issued, and that shift has happened. We don't have a vote on your investment in a SPAC, obviously. The one vote we have when it comes to SPACs is that merger. And we've seen a lot of coverage on how SPACs in some cases have rewarded the founding members because they have a special share class and they get a different payout than the retail investors. And so sometimes SPAC founders are getting a financial windfall while retail investors are not seeing any premium. So our policy that we suggest adding this year is that where there's a premium for retail investors, we're supporting that merger deal, and where there is not a premium, we're voting against. If the merger is not approved, then that dissolves and the SPAC can look for another private company to take public. Moving down to page 40, or the next page, item 14.04. Public benefit corporation. So we saw several shareholder proposals that were asking for shareholder approval for a company to change its status from a for-profit firm to a public benefit corporation. We take no issue with public benefit corporations as a way to incorporate, but we do take issue with shareholders putting this forward because essentially a public benefit corporation can offer a public good and not prioritize investment return. And so since we're investing in these companies because they are publicly traded for-profit firms, we do not want to support the conversion to a public benefit corporation. So we have a list of criteria here that we'll consider on these shareholder proposals. The most important being that the entity is not going to subordinate financial return for a public benefit. So if they were able to do that conversion and make that happen, that might be supportable. But so far, we have voted against these shareholder proposals. Moving on to item 15.05. Climate action plan. Companies, mostly in foreign markets, we haven't seen it very much in the US, are putting forward climate action plans where they are detailing their plans and goals for reducing carbon over time. We're in favor of companies focusing on climate and reducing carbon over time. We are looking at several criteria when voting on these. Firstly, we don't want to rubber stamp these plans. We don't want this to be an exercise in marketing. We want the plans to be substantive. So if the company is going to seek shareholder approval, we expect them to come forward with targets and a plan to achieve those targets in the short, medium, and long term. Another important focus for us is on the just transition piece. And that's the term of art used to describe the impact for workers and communities. So while we applaud companies lowering carbon, if they're going to close down 3 factories, we also want the companies to be reporting on what is going to happen with those workers. Is there retraining? Is there a commitment to pension benefits continuing? Is there a redeployment of workforce? What is the number for layoffs? So we want all of that information detailed in any climate action plan. We evaluate all these factors independently and then arrive at a decision there. Those are the 3 changes for the proxy voting policy. Any questions on that before we move to the slide deck?
Yeah, it looks like you're good to move on.
Okay, great. So I won't go through all of this in the interest of time. But if we scroll, yeah, this is perfect. So as you all know, proxy voting is our bread and butter, and we also do this engagement with your plan and with other plans as well. And then the third piece of our work is to try to shape the regulatory environment, and I'll brief you on some regulatory developments that we've seen recently. We can move to the next slide. All the shareholder advocacy work is done through coalitions. This is because it's much more powerful to speak to a company when you can speak on behalf of a large investor base. So while you, Siegel, and the system work directly on what companies we're going to target, and we speak independently with the companies. We're always trying to be cooperative through issue-focused groups, such as the SAMPay Working Group, the Investors for Opioid and Pharmaceutical Accountability, and I'll touch on the coalitions we work together with on diversity issues. Move to the next slide. One issue where we're becoming more knowledgeable and active on is climate. As Segal-Marco joined Ceres, which is an environmental organization that connects shareholders and companies, and they have identified the top 100 carbon emitters and then organize investors to engage those companies through Climate Action 100. So we see climate as one of the most important ESG issues going forward, and I know the system is interested in doing some work on climate. So we'll be looking at that for the next filing season. Moving on to the next slide. The IOPA, this is the Investors for Opioid and Pharmaceutical Accountability. You've heard me talk about this for the last few years. We're still continuing the work. We are moving to the stage where a lot of these lawsuits against these firms are being settled. So our asks have changed. If we move to the next slide. We wrote to the companies that we've been engaging through the IOPA and asked them to stop the practice of excluding legal costs from their executive pay calculations, as I explained when we were talking about US Silica. And some of these companies have been responsive in providing more transparency, which is a great first step. We want to see exactly how they're calculating these executive payouts. But ultimately, we would like to see the company stop this practice. If we move to the next slide. So we voted against the SAMPay plan at AmerisourceBergen, Johnson & Johnson, and Cardinal Health as a tool to help bring the companies to the table on this issue of executive pay. Those vote no campaigns were successful. We saw high opposition rates to those SAMPay votes. And then we were able to talk to the companies about changes they could make to help engender more support. We move to the next slide. McKesson was the first company that docked CEO pay because of opioid litigation. None of these companies have admitted wrongdoing, and we see their insistence on excluding the litigation charges as a further sign that they're not holding executives accountable for the various missteps in handling the opioid crisis. So we were very pleased to see McKesson come out and reduce the CEO pay by $3 million. It's not a very large figure because it's a fraction of what the CEO gets annually, but it is dramatic in the sense that it's the first time these companies are saying, we have these opioid litigation charges, it costs shareholders, and so we are penalizing the CEO. If we move to the next slide. Cardinal Health followed suit, so they docked CEO pay by $1.4 million. And again, it's not just that they dock the pay, it's that they make very clear in the proxy statement that they're docking pay because of opioid litigation. If we move to the next slide, there were two proposals that went into AmerisourceBergen and Johnson & Johnson, and the shareholder proposals asked them to stop this practice. AmerisourceBergen, the proposal was withdrawn because AmerisourceBergen also reduced the CEO pay by $1.5 million. At Johnson & Johnson, that meeting was just recently voted, and that proposal had 48% support. But the company did not penalize CEO pay at all. So we will be continuing to focus on Johnson & Johnson. Moving to the SAMPay Working Group, this is a list of the members here. We can move to the next page. So these are the three companies we reached out to, as I mentioned in the memo. You can see the numbers here. So at Hilton, CEO pay increased from 22 million to 56. At Park, from 6.5 to 14. At Xenia, from 5 to 6. So pretty significant increases. You can see the total shareholder return within their peer index. So they had very poor returns, and we had a large layoff of the workforce. So our group reached out to those companies and asked them to include a customer satisfaction metric. the link between customer satisfaction and having staff at the hotels is very closely linked. And so if the CEOs are rewarded with partly with a customer satisfaction metric, that would help create an incentive to make sure that they have a workforce. These companies are now struggling to fill positions. Moving on to the next slide on diversity. The two coalitions we work with are 30% Coalition, which is a national organization, and then a regional organization as well. You can see the numbers here. The numbers for City of Philadelphia, we report to you annually, but it's important for you to understand that you're also you are helping this larger movement where your efforts on diversity are being compounded by all the other members who are also engaging companies on this. Moving to the next slide. I just want to make you aware that Siegel Marco's ESG committee, which I'm the chair of, is starting to rate managers on ESG. So we have completed rating our recommended equity strategies and recommended fixed income strategies, and we're moving on to private markets. So to the extent that's of interest there, I wanted to let you know. Next slide is a review of recent regulatory developments. What's important for you to know is that the DOL in October released a new rule on proxy voting and ESG, and it was very supportive of exercising proxy voting rights and investing in ESG. The final rule is still outstanding. We're waiting on that. Additionally, the SEC has put out a proposed rule on climate disclosure. They are going to require companies to report lots and lots of data on climate, their carbon emissions, the impacts from extreme weather events. They're going to require the impacts be audited by an independent financial institution. So the proposed version is out. The comment window closes on June 17th, and then we'll see a final rule. But this is good news for investors because we will, if the final version looks similar to the proposed version, we will finally have comparable data on climate, and we will be able to see more precisely if there is a correlation with performance. Also, the SEC is expected to release a rule on human capital management next month that would require companies to report out on DEI statistics, as well as workforce health and safety, worker retention, a number of other factors. So we can move forward. I'll just quickly touch on voting, and then I will leave you to your meeting. So you can continue forward. We went through these, so please, yep. We covered these already. All right, proxy voting summary. Very quickly, just a few slides here. We voted about 7,500 companies for you in 2021. That was about 80,000 proposals. When a proposal comes on a ballot, it always comes with a recommendation from management, whether to support or oppose. And we voted in alignment with the corporate recommendation 54% of the time. The next slide has a review of our election of directors. We voted against 60% of directors up for a vote. We vote against if they lack diversity, if performance is poor, if there's poor attendance, or if they have ignored a controversy or shareholder action that received majority support. Next slide shows auditors. This is a straight vote for us. If 20% or more of the total is for audit-related services rather than the audit, then we're voting against. A firm can always hire a second auditor to do consulting work. We don't want too much consulting work put on the same auditor because it might compromise a clean audit. And next is the advisory vote on executive compensation. We voted in favor of 56% of these plans. Our primary criteria is ensuring that pay matches performance. So if a company is outperforming, we're okay with them paying their CEO more than peers. We also look at several other factors, including the CEO to median pay ratio. And then the next slide is on shareholder proposals. We typically take a point of view and stick to it on shareholder proposals. So for issues such as gender pay gap, we're going to vote in favor of companies looking at that every year. The same with political disclosure. We like political disclosure, so the 12 times we saw that issue come up, we voted in favor of it. The one deviation here for support is on the human rights risk assessment. There was a proposal at Home Depot on reporting on prison labor in the supply chain. And while we support that kind of reporting, Home Depot had already prohibited the supplying from any products that were from prisons. So we didn't think that proposal was necessary. The next slide has the list of accounts that we track and vote for you for proxy voting. And that wraps it up for my update.
Great, thank you. Any questions? And Jim, do we need motion to? Oh, sorry, you got a question? Yeah.
Yeah, I'm sorry. Thank you, Maureen, for the presentation and for the action y'all doing for the board. We really appreciate it because proxy voting is a very detailed and tedious thing. But I want to ask you that you talked about ESG, right? And you work with the 30% coalition because I get a lot of information from them, right? Do you also work with CFA institution?
The CFA
Go ahead. I'm sorry.
Yeah. So the CFA Institute doesn't have, they don't do coalition work, but they do reach out to us. I talked to them when we were drafting our comment letter on, to the SEC and the DOL. So I have talked to some of their researchers there that are commenting. So we're in touch with them, I guess is the way to say it, but we haven't partnered in any kind of advocacy. They don't really do direct corporate advocacy.
So, but what you talk about ESG.
Mm-hmm.
Where does DE and I come in with that? Is it a combination, or does it stand alone, or? Yeah. Is there something else that you're promoting on our behalf, or no? Go ahead.
Yeah, no, yeah, thanks for the question. Sorry, after all these years, I talk in acronyms. So ESG stands for environmental, social, and governance. So those are typically the kinds of topics that come up through proxy votes. Mm-hmm. And the S is social, and so that covers DEI. So looking at racial and gender demographics of the company, of the staff, looking at the board, looking at pay practices, if they have mandatory arbitration for sexual harassment claims, any of those kinds of topics. They're topics for proxy votes, but they're also topics that companies deal with, that we engage on shareholder proposals with. So that is under the S of ESG.
So when you say that going forward, y'all want to start looking at the investors, fixed income, private equity, is that going to be also under the umbrella of the diversity, equity, and inclusion?
Yes.
Okay.
Yeah.
So is that going to look at how boards have changed due to the George Floyd situation or the diversity, equity, inclusion? Because I think every investment company is supposed to have a DE&I or proposed to have a diversity, equity, inclusion set of rules and regulations. So I guess I'm asking also, do we need a separate set of codes for the diversity, equity, inclusion, or the code under the umbrella, being under the umbrella of the S in the ESG, it will sustain us?
Yeah. So the ESG, so for the scores that I mentioned, we're looking at DEI as part of that scoring. But we also have, and I don't want to put Rosa on the spot, my colleague is Rosa Lemus is sitting in, and she handles a lot of our DEI work. But she's also working on looking at the staff of the asset managers themselves, and then looking at how DEI is used as a data point to figure out which companies to put in your strategy. So it's two levels. It's, Mm-hmm.
So we can almost say that we kind of like need a separate set of codes for diversity, equity, and inclusion. Me and acronyms are getting mixed up right now, so forgive me.
Yeah.
So to work along with what Rose is doing.
Correct.
Is that correct? Who said correct, Rose?
No, so there are some for the diversity, equity, and inclusion directly with the investments. While Maureen's team on the ESG committee is working on these ESG scores, we wanted to take it a little bit further with respect to the strategy, the investment strategy, also taking a look at the investment manager firm at the firm level and looking at their diversity practices, their policies, and their governance within that investment manager, very, very specific to the investment manager. And then looking at their diversity practices of inclusion and belonging for the portfolio managers that manage that strategy. So taking it a little bit further as a supplement of our research due diligence and looking at how well they're applying their diversity elements, expanding the diversity to the portfolio managers as opposed to just the ownership, because there's a lot of window dressing there sometimes. So looking at who the portfolio managers that are managing those strategies, are they diverse, and what are the human capital policies affiliated with those strategies, and providing a score so that it could be a supplemental in our due diligence with respect to recommendations of the strategy in itself. Also, it also helps us further down the road in order to have that correlation with respect to their diversity practices and their performance.
Okay.
Carol?
Yes.
It's Jim.
Yeah.
Thanks for bringing that up and asking Siegel Marco. Just as a reminder, as part of our collaboration with Councilperson Gilmore Richardson, we, the board, voted to incorporate ESG considerations into its IPS so that whenever we're considering an investment manager or making decisions about investment managers, we look at ESG factors, including the DE&I, as one of the primary factors, as well as, of course, fiduciary investment returns and other fiduciary considerations. So we do have it as part of our IPS, and it's in the board's DNA with respect to monitoring and asking the investment managers about their board composition, about their employment composition, and so forth.
Okay, I just wanted to bring more of the fact out about diversity, equity, and inclusion, Jim, which is become a stronger advocate or element, I should say, since the George Ford incident. And a lot of companies have proposed or indicated that they have diversity, equity, inclusion policies by which they go by. And I just wanted to know where we stood on that. And I know it's a part of our ESG and a part of what we did with the councilwoman. I just want to know, we were supposed to have our own committee and I guess have some more detailed requirements for codes, policies done. So I just wanted to know how inclusive was D&I under the ESG, how strong it is, and like, do we need to break it off? I think we do, but that's a conversation we going forward. I just wanted to know where Marco and them, and thank you for bringing that up, Jim. I just wanted to know where it fits in the Marco, Siegel Marco plan of ESG, proxy voting and stuff like that.
Yes, no, that's fine. Thanks, Carol.
So thank you. Thank you again. I appreciate everything. It's very informational.
Are you good? You good, Carol?
Yeah, Bob, I'm good. Thank you.
Good. Any other questions? Okay. Jim, do we need to take a vote accepting the changes in the policy?
Yes, we do.
is there a motion to accept the changes as presented in the Marco presentation?
So moved.
Second.
So moved and properly seconded. I will hold the roll. Brian,
I approve.
Diana,
Approve.
Marcia,
Approve.
Nick, I saw you. I don't know if anyone else is here from the controller's office. Is it you today?
I'm here, Rob.
Do you approve?
I approve. Yeah, sorry.
Roosevelt,
I approve.
Paul,
Did you hear me?
no,
So I approve.
I got you. Thanks. And Carol.
All right, Rob. I approve.
Great. Passes unanimously. Thank you very much. That takes us to the stress test analysis.
All right.
Th-
Thanks, folks.
Thanks, Maureen. And thanks, Rob. Just briefly, Marquette will do a walkthrough of their annual performance and stress test forecasts. As a reminder, this is a complement to the work that Chiron does for the board on an annual basis. At a high level, I don't think the stress tests that Marquette will discuss provide any significant surprises or outlier results. But I'll turn it over to Dave and Kwaku to walk through, and of course, they'll be happy to take questions.
Good morning, everyone. Thank you, Chris. And of course, we are experiencing a real-time stress in the overall portfolio now as equity markets have come off their highs due to rapid increases in short-term rates, concerns around inflation and geopolitical conflict. But of course, the purpose of this exercise is to make sure that we are never caught flat-footed. We will always be alarmed, surprised, disappointed by what the market brings, but we should never be surprised by the way that our portfolio responds to market conditions. We have a diversified portfolio of financial assets, equities, and fixed income that are marked to market daily. One interesting observation is that both equities and fixed income were down in the first quarter. And since the inception of the Barclays Aggregate Bond Index in 1976, 184 quarters, we have only seen 19 quarters or 19 instances where both equities and fixed income were down. That's only happened in 10% of the time. So that is a little bit unusual. But fortunately, we have allocations to private markets, diversified asset classes like infrastructure, private equity, real estate that help offset the blows from the daily marking to market of financial assets, the daily volatility. So what we are trying to gauge here are circumstances in which we should expect to see downturns across the assets that are in the underlying portfolio. We have several real-time examples, and I think we could probably advance forward, please, to the next slide. Or the executive summary slide. Two real-term examples where we've experienced market stress. That of course is the COVID crisis and then the Russia's invasion of Ukraine. And in both instances, we saw a downturn in equity markets. And as expected, a diversified portfolio like the one that we've constructed here did withstand a downturn from equity markets. Normally, a support from fixed income helps offset an equity market decline, and we are starting to see signs of that again. The 10-year Treasury reached a recent high of around 3.2%, sending bond prices back down. But as equities have continued their slide in May, we've seen a drop in the 10-year Treasury by about 40 basis points, meaning that bond prices have come back up. So we've seen fixed income resume its normal role in the portfolio, and that's protecting during periods of equity markets. I think what's really important here is just to evaluate on maybe slide 5, please, the indices that, and not unexpectedly, most equity markets were down. Large cap in particular, non-US equities were down more significantly during the Russian invasion. but our exposures to other asset classes, core fixed income, even real estate, which is not featured here, allowed the total fund composite highlighted in blue to withstand or not experience the full equity market decline from the Russell 1000, MSCI emerging markets, or developed markets. We have allocations to equities to help us fulfill our long-term growth expectations adjusted for inflation, but we are not 100% invested in equities because of the risk of downside. So we have a diversified portfolio that protects from these equity market slides. And then when investors de-risk, when investors become nervous, they sell their liquid risk assets, which are U.S. and non-U.S. equities, and then more specifically, U.S. small cap equities, non-U.S. small cap, and emerging market equities. Those represent probably the most risky public market assets. So the key takeaway from this slide is a real-time example of, during a period of market stress when equities sold off, a diversified portfolio like the one that we have here has proven to be resilient. We still experienced a downturn, but not nearly the same magnitude of downturn that U.S. and non-U.S. equity markets experienced. Any questions or other observations about that one example? And then maybe we could I think scroll forward to 7, please. Thank you. So March of course, was the 1 month in the quarter that did perform well. We did see a slight rebound, and not surprisingly, public market assets, when investors re-risked their portfolios, we saw meaningful upswings in the asset classes that sold off most heavily during other risk-off periods. So it's interesting to observe that equities have performed better. And the portfolio, which is diversified across other asset classes, core fixed income, private equity, which doesn't see that mark to market or increase in valuation on a daily basis. And we also experienced a downturn from bonds. The portfolio didn't participate in 100% of the upside. So, of course, the downside of a diversified portfolio is not capturing the full effects of a rising equity market. We do that to protect against very broad market swings. We raise capital from this portfolio on a regular basis to fund benefit payments and other expenses. And if we're constantly buying and selling new assets in a volatile portfolio, we run the risk of realizing actual losses. So a diversified portfolio helps mitigate the dispersion of actual outcomes. The downside may not be as impactful, but we're not going to capture 100% of an equity market upside. And that is the benefit of an overall diversified portfolio. More narrowing of expected outcomes. And that's one of the things that we evaluate during our regular asset allocation analysis, is trying to construct a portfolio that allows us to reach our actuarial rate of return with a limited amount of outlier experiences. So those are the real-time examples. I'm happy to elaborate further. Chris, is there anything else that's worth pointing out here, or other points that we should be making before we move into the actual stress test of forward-looking evaluation?
I think the only other question I would have is about April. Have you kind of seen anything preliminary in April, and does that look a lot like February?
Well, so I mean, April and May, we have continued to see the equity market slide. And if we distill that really into one underlying reason, it's rising interest rates. And we are now reaching interest rate levels of 75 basis points with the expectation of 50 basis points more in June, followed by another 50 basis points. I think the Fed will probably pause, reset, and reevaluate before they do anything further. But obviously, as the weighted average cost of capital increases, the value of future cash flows comes down. We have seen a repricing of assets, particularly growth assets, growth and tech assets, which reached very lofty levels following the COVID crisis. We are seeing those being repriced. And of course, and before the call started, there was some dialogue around Walmart, Target, and some recent retailers who've posted some large misses, which is attributable to inflation, probably reduced spending habits from their consumers, very slim margins, and supply chain constraints. But we are re-entering an interest rate environment that existed prior to the COVID crisis, and financial assets or stocks are being repriced back at those levels. One of the key observations that we were making this time 2 years ago is that the S&P 500 price appreciation was really driven by 8 names, the FANG stocks and a few more, which represented at that time 25% of the market capitalization of the S&P 500. 5 to 8 names represented an overwhelming majority of the S&P 5. Those names performed incredibly well and basically lifted the entire S&P 500. The exact reverse is happening now. There's about 8 names or so that now represent around 50% of the S&P 500 equity market decline, and that is a challenge.
Did you say 50?
Yes, sir, 50%. And those names, I mean, these are names that we know well, but these names specifically are Apple, Microsoft, Amazon, Tesla, Facebook, Netflix, and NVIDIA. NVIDIA is basically is a chip manufacturer associated with the tech sector. That's kind of a new name to that 8. But those 8 names represent basically 50% of that equity market decline. And things certainly weren't helped when Target and Walmart, I think, announced yesterday or the day before their disappointing miss. So that's further impacted the overall equity market sell-off.
Have you looked at in April at how we compared the comparison that we did for February and March? Are we still kind of somewhere in the middle?
Yeah, so I mean, one of the benefits, I think April through kind of month to date in May, we've seen some resiliency from fixed income as the 10-year has come down off of highs. So in the first quarter, we were impacted by all financial market assets, both stocks and bonds. Equities and fixed income came down. Now we see some offsetting benefit from overall fixed income as the 10-year Treasury has come back up. And of course, our portfolio, our private equity portfolio, our real estate portfolio, those are not marked to market on a daily basis, and those have offered some level of overall protection. But obviously, the extent that we have allocations to equity markets, we are feeling that slide. But we are being supported now by a fixed income market that's functioning as a hedge as it should, and non-financial assets that are offering some protection.
Okay, thanks.
Any other questions, observations, concerns around kind of the most recent instances of financial pressures that have come from a pandemic, geopolitical conflict, and really fiscal policy measures? And these are all things that we think about when we're preparing an asset allocation analysis. We think about asset allocation in rolling 10-year increments. Just so happens that these 3 significant events have occurred within the span of about 24 months. So we've seen a dramatic rise in overall equity prices that far exceed what we would expect over a normalized period. And just, if we reflect back over the last 5 years in particular, with the exception of 2018, where the S&P 5 was down around 4% due to concerns around rising rates in 2019, we saw calendar year returns in 17 through 21 that ranged anywhere from 18% to 30%. The long-term expected average for equities is probably around 7 to 8%. Not entirely shocking that we've pulled back from those highs, especially as the cost of capital has increased.
Hi, Dave. Dave, it's Fran. How you doing?
Hey, Fran, how are you?
I did have one follow-up question. You indicated that fixed income recently has been acting as a hedge. How do you expect that to go? I'm sorry, how do you expect that to perform going forward in a rising interest rate environment?
Yeah, good question, Fran. And that is the question that many of our clients are asking right now. So when we think about the intent of the FOMC, the Federal Open Market Committee, whose one of their key purposes is to keep inflation in check by managing the federal funds rate, the short-term interest rate, we expect the Fed funds rate, at least based on current market estimates, to increase to about, call it 3 to 3.25%. That is a rise on the short end of the curve. Based on Treasury, the forward Treasury curve, and this is a market prognostication, not some sort of evaluation by any particular firm, we are expecting to see a flattening of the yield curve. We are not expecting to see the 10-year to deviate much from its current roll. 3.2% is the trailing 12-month high. 3.2% is the trailing 12-month high. We've come down from that. Based on that forward curve, we are not expecting much movement really beyond the 5-year. Our core fixed income allocation has a duration by benchmark of around 7, meaning that for a parallel shift in the yield curve, everything moves by 1%. Bond prices would come down 7%. We are not expecting a parallel shift in the yield curve. We are expecting a steepening, meaning that the short end will come up, the rest will stay flat, meaning that the duration or interest rate sensitivity of our core fixed income should not be as meaningfully impacted as it was before. And just a long way of saying, Fran, that the pain that we've experienced from core fixed income, I think we've probably seen most of that.
No, that's good. Thank you. I think that's probably everybody's happy to hear that. So thank you for that, Dave.
You're welcome.
Hey, Dave, it's Nick. Another follow-up question for you. Do you have a sense of how our plan how its performance compared to kind of its peer kind of universe during these stress events?
Yeah, so I mean, the peer comparison numbers are usually slower to come out, and we typically don't have real-time access. We do update that on a quarterly basis. My suggestion is that a portfolio that has healthy allocations to private markets is going to perform better than a portfolio that has higher allocations to financial markets. So I would say, and this is just based on an educated and evaluation, your portfolio is well diversified. You have a healthy, maturing, cash flowing private equity program. We have a resilient core real estate portfolio, and that is protected better than other peers that have not made those allocations or are not fully ramped in their private equity portfolio. We also have many of your peers that are more significantly underfunded and that simply can't make high allocations to illiquid markets because they just can't maintain the impact of J curve, and they need to fund those benefits from liquid assets. So I would say you are probably in 50 percentile based on your diversified portfolio.
Makes sense. Thanks, Dave.
Should I move forward to maybe the forward-looking or the forecasted return, the forecasted stress test?
Sounds good. Thanks.
So again, this is an exercise that we began to conduct regularly, again, just so we are aware of future conditions, what we can expect when these events occur. And of course, they're occurring right now, and we're able to observe real time what can actually happen. So we are on the summary page. Let's see. Maybe let's go to 16, please. So what we evaluate here primarily are what happens during periods of rising interest rates, 1% or more, what happens during an equity market decline, 20%, which is a bear market. And we evaluate what happens to the underlying asset classes in the portfolio. What this stress test doesn't really allow us to contemplate are the correlation or the diversification benefits, the movement in tandem of one asset class versus another. And just to use an example, under normal market conditions, when equity markets are up, when equity markets are down, bond markets are up. That represents a negative correlation. Assets like U.S. large cap, U.S. mid cap tend to have a higher correlation. But when we aggregate assets across the assets that we have in the portfolio, we mitigate overall volatility. What we're evaluating here are the asset class implications during periods of rising rates or equity market sell-offs, and viewing these assets in isolation. We are not taking into consideration the benefits of diversified portfolio. So this is based.
Yes, sir. Put that another way, is it be accurate to say that this will tell us what happens with each individual class, but not with the portfolio overall? So the overall portfolio is different from just trying to, add these together, for example.
That's correct. Much more clearly stated. We are looking at the individual asset classes, and this is profiled on page 17. So fixed income is most susceptible to rising interest rates. When we have a cash flow or a yield that's offered by the coupon in a bond and the interest rates or the cost of capital increases, that net present value comes down. And we measure that most succinctly by duration or a measure of interest rate sensitivity. It's not a perfect measurement because it contemplates, again, a parallel shift. But if we were to expect interest rates to increase by 1% parallel shift across the yield curve for 1 year, we would expect the bond prices to come down by 6.6%, which is roughly in line with the overall duration. Now, of course, that price impact is offset by the fact that as interest rates increase, the yield on those bonds are increasing. A great example, year-end December 2020, the yield on the U.S. Bloomberg Aggregate Bond Index was around 1.1%. We've now seen interest rates eclipse 3%, come back down, but the yield on that benchmark is now 3.2%. So what we have perhaps lost in price, we have gained some of that back in overall yield. Now, of course, that doesn't offset the entire price compression, but we are adding more yield as interest rates increase. When equities,
sorry, I keep interrupting, but are these numbers scalable? So if interest rates go up 2%, do they roughly double, or is it more complicated than that?
Yeah, well, it's not that much more complicated. So at the most basic level, when we are evaluating, this is just maybe a more qualitative explanation. When interest rates increase by 2%, we would expect bond prices to decrease by double the amount of duration. So if the duration on the Barclays Aggregate Bond Index is approximately 6.8 years, we would expect those bond prices to decline by about 14%. However, we would be adding higher yielding bonds to that overall portfolio, which would offset. And over a period of time, that higher yield would create a break even and we would be back in positive territory. Now, again, all of this assumes a parallel shift in the yield curve. That is not what we are expecting. We are expecting short-term rates to increase from about 75 basis points from 0 to around, call it 3% over the course of the next 12 months. I would also argue that the Federal Reserve, who aspires to be very transparent and also aspires to be data-driven, will most likely pause and evaluate after their next announced rate hikes in June and July, recognizing that inflation may have peaked at CPI at 8.5%, came down 20 basis points, and with this massive equity market sell-off. So I would be, this is a personal opinion, I would be surprised if the Federal Reserve continued its aggressive pace of rate hikes without pausing and resetting after July.
Got it. Thank you.
The other key takeaways here, what happens to a U.S. equity portfolio during a bear market or a 20% decline? As expected, we would expect to see a significant pullback in equities. U.S. equities, which are more correlated than, say, a diversified portfolio of U.S. and non-U.S. equities, would probably fall a little bit more, but non-U.S. equities, of course, are usually going to follow the same direction as a global equity market as investors de-risk, especially when we see more and more indexing, more and more passive management. Rather than selling individual stocks, investors sell baskets of securities, baskets of stocks, and everything comes down simultaneously. Now, of course, when we evaluate asset classes that are not marked to market on a daily basis, we see the benefits of diversification across private markets. Real estate, infrastructure, private equity are all much more resilient in the face of rising interest rates. Real estate, and especially the real estate that we have in the portfolio, core real estate, sources return really from two areas: from capital appreciation, which is usually consistent with the level of inflation, and through buildings that are almost fully occupied. The occupancy levels of our portfolios are around 90%, meaning that these buildings are fully tenanted and those tenants are paying their leases and paying those leases on time. So the income component over the long term is around 4%. When we think about capital appreciation over the long term and the income component that's generated from core real estate, we would expect, regardless of interest rates in a 1 year period, to return somewhere in the neighborhood of, call it 7.5% to 8%. Infrastructure is an asset class that tends to be more resilient in the face of inflation or contracting GDP conditions. Usually these are assets that require or are needed regardless of economic conditions. These are assets like energy transmission, water transmission, cell phone tower usage, data usage, but we also have access or exposures to more GDP sensitive asset classes in infrastructure, ports, seaports, et cetera, that tend to be a little bit more sensitive to changes in economic conditions. The key takeaway here is that infrastructure like real estate is not expected to materially deviate if interest rates increase. And the same is true with private equity and private debt. Private equity, our purpose in private equity is investing in companies that will grow over the long term. And the valuations of these companies are not particularly susceptible to changes in interest rates. Private debt is a great asset class to have during periods of rising rates. Private debt is issued with is a variable rate debt, meaning that as interest rates increase, the yield sourced from private debt increases as well. I talked earlier about the duration or the interest rate sensitivity of the core fixed income portfolio being 7. The duration of most private credit portfolios is around 0.25, meaning very, very little interest rate sensitivity. That's an asset class that's worth having during periods of rising interest rates. And then when equities decline, we do tend to see a markdown of infrastructure due to some GDP sensitivity. And then we do observe that private equity still follows public market comps during periods of equity market decline. One interesting observable point, when we think back to private equity valuations following the tech bubble in 2000 and the global financial crisis, and we have some great charts that illustrate this point, the markdown was less than what we saw. The markdown in private equity was less than we saw in public equity, and the recovery was more significant. So there is some observable downside protection across those two periods, global financial crisis and the tech bubble, where private equity wasn't marked down as much and the recovery was much more significant. Again, underscoring the merits of having a diversified portfolio of both public and private market investments. Did I alleviate everyone's fear? Are we now comfortable?
I think if people aren't scared now, they're not really paying attention.
Dave, no follow-up questions for me, but I just wanted to thank you for putting this analysis together. It's at least reassuring to see, there are no surprises really, but reassuring to see the plan's performance as we continue to go through scary times. So thank you.
You're welcome. Thank you.
Yeah, thank you very much. It was a really informative presentation. Anybody else have any questions, comments? All right, thank you very much. That takes us to the MWBTB&E and local brokerage update.
Thanks, Rob. Brief report on the brokerage program for the first quarter of 2022. Really positive news, I think, on all fronts to report. 60% of the board's equity trades went to qualifying local minority or women-owned brokerage firms. It's only one firm, Emerald, below the aspirational target. But as a whole, again, 6 out of every 10 trades, essentially 60% going to qualifying brokers.
How is the trend for Emerald?
Rob, they've long hovered around that number. We have conversations with them as we do with Logan Circle, MetLife. They indicate that the discussions with the qualifying brokers are ongoing. That they use the best, available broker in terms of execution and pricing for given trades. And for whatever reason, they, I wouldn't describe their number as poor, but it does come in, I would say, around that fairly consistently. Discussions and, offers to connect them with brokers, as we do with MetLife, will continue.
Thanks.
On an individual basis, I think similar story for the fixed income managers, all but MetLife, who I just alluded to, were above or at their aspirational target for the quarter. Because MetLife had the most total principal traded, that's why you see the overall number at 34%. But again, you see Sim, Garcia, Lord Abbott, Rumline, Longfellow, all above or at, in the case of Lord Abbott, their aspirational target. And then again, page 3, which I skipped over, shows the breakdown in commissions for individual, brokers during the same time period.
Thanks. Are there some questions about that? Okay. That takes us to the investment performance review.
Sure. Thanks again, Rob. Just wanted to dovetail, and I'll be brief on, some of the comments, Dave made in terms of, overall market commentary as it relates to the stress tests, and to Nick's question about how we compare to peers. I mean, I think one of the challenges the market's going through right now, in addition to what Dave said, which I think is wholly accurate on interest rates, is that there's still a lot of conflicting data, sometimes coming almost, contemporaneously with each other. I think Fran and Dave may have mentioned, Target yesterday. What was interesting about Target and it going down was just the day before, 2 days before, we had seen on an overall basis, retail sales had gone up by nearly 1% in April. But then what we saw from Target was that while their total sales grew 3+%, which was much, much higher than expectations, their net profit actually dropped by 50%. And that was a drastic deviation from what analysts had expected. So we saw, consumer spending, more, but they were shifting away from discretionary items and having to spend more on food and other household essentials because of inflation. At the same time we're seeing that, however, we're seeing an increase in travel spending. We're seeing an increase in restaurant spending. And a shift away from kind of buying goods to services. So I think the market is, wrestling with conflicting data like that. We are seeing an uptick in delinquencies on some subprime loans and credit cards. They jumped up about 1.2% last month. So that's something to keep an eye on. The Philly Fed and New York Fed manufacturing indexes came in, with really poor readings this morning. In the case of the New York Fed, there was an expectation for around 16. It actually dropped all the way down to 11.6, and it was at almost 25 last month. Gas prices continue to rise, 16 cents more than last week, 39 cents more than March. Home sales dropped nearly 2.5% last month. And we have started to see some, at least initial signs of panic selling, at least in some asset classes on Wall Street. To Nick's point, I do think the portfolio has behaved as expected, as Dave alluded to. It's hard to get real-time data, but the data we're able to track, the reports that we're able to see, I do think the plan is holding up. Not only as expected, but as well or better than some of our peers. The Wilshire report that I sent an email out about a couple of days ago, I think offers some credence to that. Initial preliminary stats from a different database that Marquette uses, Investor Force, I think had us in the top 20 or 25% of our peer groups. And we have started to see data trickle out from some of the surrounding counties in Pennsylvania, the ones that are almost exclusively indexed, and their returns through March were significantly lower than what we experienced. So again, no one likes down markets. They're never fun, but preserving as much capital as you can on the way down is crucially important for, when the rebound eventually happens. No significant or actionable concerns with any of the individual.
So, Chris, sorry,
Yep.
just to summarize what you're saying, our portfolio is performing the way we would have wanted it to in this type of market. Is that essentially what you're saying? It's giving us the protection on the downside that we would have wanted.
Yes, I mean, and I think that's exactly right, and I think it's giving us significantly more downside protection than if this portfolio had been constructed differently. I think Wilshire also provided the stats on what 70-30, meaning 70% stock, 30% bond indexes or portfolios, or 65-35 would have looked like. I think for the same time period through March, again, that type of portfolio performed significantly worse. And again, I would kind of shudder to think about how the portfolio might have performed had the board not made the changes it did going back as far as 2016 or 17. I think the board has done a very good job, re-engineering, reconstructing the portfolio to provide protection as much as we can get during times like this. No actionable concerns with any of the managers. Again, most asset classes, if you look at, and given that we've almost exclusively moved out of opportunistic fixed income, I'm kind of ignoring that one because of how little remains. But the asset classes either were in line or generally outperformed their policy targets, which is a good thing. And again, kind of bolsters the point with the questions that were just raised. I will turn it over to Kwaku and Dave. Again, happy to take questions. They're also going to run through a brief memo regarding the benchmarking of Elizabeth Park, which was a question that was raised at the April meeting.
Okay, thanks.
Happy to take any other questions about portfolio performance, but I think we've covered that well already, and Chris' summary was right on point. Should I just move forward to this memo?
Yep, unless anyone has questions, that works.
So the purpose of this memo is really to explain the benchmarking that we use for Elizabeth Park, which is the sole remaining hedge fund of the portfolio, and it's a long-short strategy that is focused exclusively on financial services, primarily regional banks. And with any sort of strategy that's going to be sort of unconstrained, it becomes challenging to benchmark. This is with the S&P 500. We are able to go to the market and replicate the risk and return characteristics of that benchmark by buying the underlying stocks and representative weights. There isn't an exact benchmark that exists to measure what this particular strategy is doing, and that's taking positions based on fundamental observations on the conditions of regional banks. So when we think about the underlying benchmarking that's available, we tend to gravitate towards two that are profiled here. The HFRX event-driven index, which takes into consideration strategies from other event-driven managers. These are managers that are taking positions in mergers, restructurings, financial distress, shareholder buybacks, debt exchanges, a wide variety of different events that managers can use to extract value. Now, that index is much broader than the specific positions that Franklin Park is taking with a long-short equity strategy in regional and community banks. Nonetheless, we do think it is appropriately representative of a hedge fund strategy that's based on event-driven securities or event-driven actions, but it's not going to be exactly aligned. The other primary benchmark that we could potentially use would be the NASDAQ Bank Index, that is a capitalization-weighted index of domestic banks. Now, that doesn't necessarily take into consideration the shorting that Franklin Park is engaged in and is part of their strategy, but at least it allows us to narrow in specifically on financial services and underlying banks. So the underlying sector is going to be very closely aligned, but the strategy is going to be different. I think the main summary here is that benchmarking a strategy like this, there isn't going to be an investable universe or an exact or underlying representative benchmark. So we use what we think are the closest approximations of how this strategy will perform. And again, that's the HFRX event driven and the NASDAQ Bank Index. We will see deviations from the S&P 5 simply because, or other U.S. equity indices, because those are capitalization weighted benchmarks that are driven by overall market cap, large, mid, and small. Many of these community banks, these regional banks are small cap, would fit within a small cap index, but a small cap index is going to be, heavily favor, it could be technology, could have financial services or other industrials materials. It's much broader than what we're trying to accomplish or evaluate here. Are there any other concerns or observations around Elizabeth Park or the benchmarking methodology that we're using?
It doesn't sound like there's any really good fit for benchmarking for them. So it sounds like we're saying is overall we just have to look at kind of what we want the manager to do and kind of see how it performs against those expectations without relying as much on a benchmark as we do for some other managers. Is that?
Yes, sir. This is we think that these benchmarks are the best possible fit. The other way that we can think about this strategy is the opportunity cost. If we weren't allocated to Elizabeth Park, where else would those assets be? And in all likelihood, they would either be in the S&P 500 or the Russell 1000 or the Russell 2000. And if we're observing or able to observe periods of protection when those markets are down, and I think if we look back at back at performance over the course of the last quarter, Elizabeth Park is down, but not nearly as much as the overall broad market U.S. index. So we can observe periods of protection from a unique strategy like this. This is another way to conceptualize whether or not this manager is adding value relative to the overall portfolio.
Got it. Thank you. That's very helpful. Any other questions? Okay. Thank you very much. That takes us to staff report.
Sure. On securities lending, $133,204 in income for the month, $432,153 year to date, and $50.822 million since the inception of the program. On the diversity and local AUM front, slight increases month over month. On a combined basis, just over 28%. Diversity managers broken out separately, 20.23%, and Philadelphia and surrounding counties, 9.33% in fund assets. The upcoming board meetings as presently calendared are June 23rd, July 28th, and August 25th. That concludes staff report, absent any questions from the trustees.
Any questions?
Yeah, so good morning. I have a question.
Good morning.
So, Chris, who's the representative on staff now for CFA and the 30% coalition? I know it used to be Aaron, so I mean, I get the minutes and stuff, but do we still have someone on staff? Excuse me, I'm getting a cold. Do we still have someone on staff that follow up with that?
Yes, various folks will attend the meetings, but I think it would be fair to say that Dominique spearheads a lot of our efforts with those particular groups, on a monthly basis or as those meetings arise.
Okay, so my question is, because we're having a hard time getting the Diversity, Equity, and Inclusion Committee together, nobody wants to get on it. Would it be possible that maybe Dominique along can work with 30% Coalition and give us some type of policy or code language concerning the D&I so that we can strengthen up our policy under the ES&G? And maybe just get some language that would satisfy what we want to go for as a requirement instead of fighting to try to get a committee together since that's fallen by the wayside.
Are you talking about what language for our investment policy?
Well, we can add it into our investment policy. I mean, I think at this point, Rob, we need to strengthen some of the language under diversity, equity, and inclusion. And I know, I don't know if you get it, Rob, but I do get a lot of information from the 30% Coalition and CFA concerning that. And I saw where they did adopt policies just on diversity, equity, and inclusion in and of itself. So, I mean, maybe it's not adopting more, maybe it's comparing to see if it is if that our policy is in line with that policy or if we need to tighten it up. And then, you know what I'm saying?
Yep.
I'm not
Okay.
looking to say change the policy, not like that. Just to see maybe it may be some bullet points or some points that we may need to strengthen our policy up on.
Okay.
And it may not be. I'm just
Right, I
saying,
understand. Just want to see what it is. That works for me. If no board members have objection, I think that makes sense. Okay. Any other new business? Any old business? Then it has been moved and properly seconded that the investment committee is adjourned. I'll call the full board into a session. There's been a motion made and properly seconded to adopt the actions taken by the investment committee. I will call the roll. Brian,
I approve.
Diana,
I approve.
you, Marcia,
Approve.
Roosevelt,
I approve.
Paul,
I approve.
Helen,
Approve.
and Carol.
approve.
Motion carries. Is there any new business? Any old business? Then we are adjourned. Thank you all. I will see you in June.
Okay.
Thank you.
Bye.
Thanks,
Bye,
everyone.
everyone.